Yes, everyone, welcome to the next video. So in this one, we're obviously moving on from the bonds and the yield relationship that we looked at, and we're going more depth into the yield curves. Now, this is probably just as important as understanding, just bond prices and everything, because economists actually use this to determine what part of the market cycle they're in, but also when it comes to day-to-day trading, particularly with bonds. Now, a yield curve is a chart representation of the different interest rates paid by bonds of different maturities. So these maturities can range from 3 months all the way to 30 years. The actual bond yield curves that we usually look at is a 2-year and the 10-year. Now, the three key types of yield curves include normal, inverted, and flat. The upward sloping yield curve, also known as the normal yield curve, is where longer term bonds have higher yields than short term ones. In terms of normal curves, they always point to economic expansion. So that means where the economy is growing as normal. However, a downward sloping curve, also known as the inverted yield curve, points towards an economic recession that may happen in the future. And this is actually used as one of the indicators to identify when there's going to be an economic crisis very soon. And the yield curve rates are published on the Treasury's website every single trading day. Of course, you can understand that people who actually trade bonds, the bond contracts, they will use this bond yield curve to their advantage. Now, because we trade Forex and obviously just currencies, we won't use this, the daily yield curves as much, but rather we'd use it for a long-term perspective on the market. So the first yield curve that we're going to be looking at is the normal one. So the normal yield curve slopes upwards, showing that short-term interest rates are lower than long-term rates. As you can see here, the 3-month would show the lowest yield, and then of course the 30-year would show the maximum one. Now this obviously points to economic expansion, and investors who invest into the longer-term maturity yields, they actually expect a larger yield, and that would make sense, right? The reason is because they want to be compensated for the risk of the long-term hold and how changing interest rates can really affect it. So as you can understand, over time, interest rates changed, obviously monetary policies and everything else. So the investors who are involved with the 30-year bond, they're more exposed in the market. Therefore, they want to be compensated in some way. Therefore, the yield is expected to be higher. However, this is not always the case, as in the case of the flat yield curve. So what you would see is similar yields across all maturities for bonds. There's a slight variation of this as well. And if I was you, I'd even search up certain images and search up online as well. But there's certain humps when it comes to the central maturity. So that could be around the 2-year, the 5-year, the 10-year. Around then, you might get slightly boosted one. That's something interesting to read about as well, because it doesn't happen too often. Now, what this implies is an uncertain economic time. So when you get flat yields in every bond market, where you might be approaching a crucial point of the economic cycle. So I'm just going to draw it on right now. If you think back to our economic cycle, we move in waves like this, right? The times that you would actually expect a flat yield curve potentially would be around this area where you start to see some flattening out. Now, this bit here, or you could even say at the peaks or the bottoms, that's when you get the inverted yield curves, which we're going to look at next. Now, for example, it could come to a time where there is a slowdown in the economy, and potentially you can see an inverted yield curve due to the impact. So just in reference to that again, the flat yield curve, so this is where the normal yield curve would occur because the economy is growing. Eventually, you're going to get to a flat yield curve before the inverted. Then if the flat yield curve continues and the market is responding in that way, then you're going to get inverted, which signifies that you're going to be going into recession. So the inverted yield curve. We can use the yield curve to predict the future of the economic cycle, as we just explained. Now have a look here. In early 2007, you can see that we started to get a downward sloping yield curve. So this is in January back then, and we started to get downward yield curve. Rather than seeing the upward yield curve that we'd usually expect, this was happening at the time. And exactly 1 year later, in mid 2008, the business cycle declined. Therefore, especially a few economists actually pointed this out, and many banks, or many of the smart banks at the time, JP Morgan, they actually prepared themselves for this, saying that they were diversifying their assets, for example, increasing gold assets and everything like that. But rather, it's the fact that they actually knew the recession was going to come. And one of the main indicators is this. So, guys, whenever you're looking more into yield curves and everything, actually look to see what's happening. And if you see an inverted yield curve, that's when you know an economic recession is bound to happen. Now, it might not be an immediate reaction. Of course, this one was from January 2007, and then we didn't get the crisis till much later on in 2008. It's a much longer term indicator. Just obviously one thing to understand as well with this, quite obvious, but the lower term maturity bonds, they have a higher yield at the time than the longer term maturities. And this just signifies, we're not in an economic expansion, because usually you'd expect the opposite. So just briefly wrapping this up as well, explaining the yield curve and the economic cycle. So during economic growth, there's low interest rates. Yield curve is normal and it's sloping upwards. So the longer term bond holders want their premium through a higher yield. The long-term bond holders expect an overheated economy at some point, so interest rates will increase to combat this. So you've got to refer back to inflationary conditions. What happens when the economy is growing at a pace where inflation increases and everything. They expect an overheated economy, and what's the result of that? The Fed will um, eventually increase interest rates to combat this. Now, when this overheated economy does happen, there will be rate hikes, so rise in interest rates to cool down the economy and deflate. So there's two choices. The yield curve either flattens or inverts if the effect is way too strong. Now, during the cool down, to not cause a recession, the Fed will revert back to lower interest rates, which reduces long-term yields and increase in short-term yields. So if you were wondering why we actually do invert at the time, it's because when we're at the top of the cycle right here and you start to see a recession happen, you can't be increasing interest rates any further, right? Because you're just going to be triggering that even more. Unemployment will increase to a crazy amount as well. So that's why the Fed reverts back to lowering interest rates. And that's when you start to see long-term yields reduce and short-term yields increase. And that's where you start to get the inversion happen. Of course, the flat yield curve occurs first, and then the inverted yield curve if the effect is large enough. Now, during a recession, interest rates fall, and so stocks become less attractive as they become bearish. So you can understand during a recession, stocks aren't going to be as promising as they were when the economy is moving as it should, or, growing. So this increases the demand for bonds, raising their prices due to the theory of supply and demand. This is quite simple. The more people that are buying, there's an increased demand for the bonds, more people are paying for them. Therefore, there's less available. And of course, their prices increase. So as prices increase, yields drop. And that's exactly what you get. Now, really and truly, take note of this page right here. Actually keep it in, wherever, because this is one of the most important lessons that I'm going to be teaching you. It's actually understanding, why does the economic cycle happen? So why do you see this? And what causes all of this to happen? And what are the effects of it, especially in the bond market? Because as we know, the bond market is so related to the government, their monetary policies and everything that they do. So what's good to invest in during a recession? Now, with normal economic growth, the two main asset classes that people invest in is in both stocks, which can bring substantial gains. You might see pro 20% gains in 1 year. And the second type is long-term bonds that yield a substantial amount. And that's exactly what we see, where the yield is higher during normal economic growth. However, during a recession, stocks tend to drop hard as many companies cannot function as normal. Therefore, they lose their earnings. Investors sell stock, stock supply increases, price drops. So think about supply and demand is in that as well. And of course, this has a lot to do with the actual health of the stock and how well it's performing. In terms of bonds, the Fed will lower interest rates during a recession to promote some kind of growth in the economy. Therefore, yields on the bonds drop as the interest rates and bond yields correlate. Bond prices then increase in price whilst the yields are very low. What this means is if you're investing into overpriced bonds, even then you're still not achieving the interest rate return that you can expect in a thriving economy. As a result, you can incur losses. So if it's in a time of recession and you're investing into bonds, but bond prices have gone up because of the demand of them, and you say, okay, I'm going to be investing into a bond right now at the peak, it's something that you truly need to consider because first of all, you're paying a very premium price for a bond that that you could find a discounted price afterwards, or even perhaps not afterwards, but before this all happened, it would have been the best time to buy that bond. Furthermore to that, interest rates are reduced, therefore your yield on that is not very high at all. So you might have an overpriced bond, but it only increases this much in a whole year, just a tiny bit. Whereas before, you would have seen increases this much. So what's good to invest in? Now, when the time is right and you can expect bond yields to rise in tandem with interest rate hikes and bond prices have settled slightly, then that would be a good time. So it's during the confirmation where the Fed, release some kind of announcements that they're going to be increasing interest rates. This is something that's discussed in FOMC meetings and, other announcements from the Fed. That would be the perfect price to invest into bonds. Now, take some time to understand this whole lesson. Now, question yourself, what's the impact of a recession? What happens with lower interest rates? What happens with a rate hike? So when interest rates are increased? And where can you expect global investment to go? And that right there, global investment is the main thing. You've got to understand where investors are putting their money and what effect that's going to have on the market. If you understand that we're in a recession, what do investors usually invest in? How does that affect the USD, for example? How does that affect all of the other currency pairs that I'm looking at? Once you understand this, the relationship between bond yields, yield curves, and interest rates, we can effectively predict the economy ahead of time. 100%, I'd advise you, out of all the lessons, research more about this as well. Get your head wrapped around it fully, because this really ties into the market cycle, into where we see the price of the US dollar, for example, everything like that. So it's one of the key lessons we've learned up until now. So yeah, guys, I hope you enjoyed this lesson. Definitely take some notes as much as possible. But yeah, anyways, I'll see you in the next lesson. Take care.